Hello and welcome to ET Now. You're watching IPO Central, and my guest today is from AEQUS, is one of the prominent players in the aerospace industry, a vertically integrated player. And joining me today is Aravind Melligeri, who is the chairman and CEO of the company. The company's IPO is opening on December 3rd, closes on 5th. 118 to 124 is the price band for the IPO, and it's raising fresh shares of worth 670 crores and OFS of 252 crores. So a total of 922 crores is the IPO size. The market value of the company is little over 8,120 crores at the upper end of the price band. Arvind, thank you very much for joining us today on ET Now. To begin with, sir, just take us through your business model. You are one of the prominent players in the aerospace industry, providing equipment and parts to global OEMs. Give us how the structure is of your business.
Thank you. Thanks for the opportunity. AEQUS is foremost India's foremost aerospace focused, vertically integrated ecosystem builder, and it's highly precision engineering manufacturing activities we carry out, and we have built this over 15 years. We make more than 5,000 part numbers, and for global OEMs like Airbus and Boeing, and we are vertically integrated all the way from forging, machining, surface treatment through the joint ventures and partnerships. And it's a unique kind of ecosystem that we have built over 15 years. And so that itself is a got an award from Airbus as the Innovation Award, one of its kind in the world. So something like that delivers parts to all over the world to the various aircraft programs for our customers. So that's what our model is, and we are also expanding to consumer side of the business, and we are consumer electronics is one of the large activities we have started, and over the last 24-36 months we have invested in this business, and we have continued to grow the aerospace along with our consumer business in the coming years.
Give us a sense. You're raising for a fresh issue of 670 crores. And if I'm not wrong, there was a pre-IPO placement also of 144 odd crores that happened earlier, ahead of the IPO. Where is this amount going to be used for?
It's predominantly being taken care of the existing debts, and then also investing in some of the new capacities, and we're keeping some amount for the general corporate purpose and investing in the potential joint ventures and partnerships that will be developing as we go forward. So predominantly it's going towards the repayment of the debt.
You have some of the prominent aerospace OEMs as your customers. What is the kind of order flow or visibility of orders that you have?
Typically, as aerospace industry is a very long cycle industry, and our contracts are 5 to 7 year kind of contracts, and we have a very good visibility for our business, and typically our customers are signing up the 5 to 7 year contracts, and we have been doing this for 15 years, and we continue to grow, and over the last 4 years we have grown 20+% on aerospace side of the business. We continue to do that, and we have good visibility to do that in our business.
As you build out your business, you have also brought in a lot of debt. Will the IPO proceeds be used to pay out the complete debt, or you'll still retain some debt after the IPO is over?
As you know, the aerospace industry or overall precision manufacturing industry is a capital heavy industry, and we continue to expand. As for expansion, capital is required. As we continue to expand our businesses, although we are going to repay the debt, appropriate debt level has to be maintained in the business over a period of time, and will be, as we are expanding, that will continue to happen in the business.
I was asking this because you have an EBITDA margin of 15.5%, 15.6% or so, but yet your profitability is, you're still not profitable in that sense. You are loss making for the first half there of nearly 17 odd crores. This has come down a bit, from the full year number of 102 crores of losses. What is the path to profitability for you from here on?
If you really look at it, our business, we need to look in two pieces. One is our matured aerospace business, where we have invested over the last 15 years, and it has been a profitable business, and it's even a profitability of at a profit after tax level. And then we have a consumer business. We are continuing to new investments are coming into there, and that's utilization is low because it's early stages of the business. And as the utilization improves, that will come to the profitability. And at the same time, our aerospace is fully, full utilization is happening, and profitability is there. And also we continue to grow there through the investment. Some of the capital investments, capital raise we are doing right now through the primary issue is going towards the acquiring more capital in the business, putting into aerospace business. So it's a truly we are a profitable, matured aerospace business, and on top of it, we are adding consumer vertical because we want to be a diversified, manufacturer, a precision manufacturing company, and we believe this is an opportunity to do this. And we are a growing company. We continue to invest on both the verticals because the opportunity to grow in aerospace is very large, and we continue to grow this business because addressable market is fairly large in this business. And if you see the aircraft industry, especially commercial aerospace, where we are focused on, is growing quite a bit, and we are very much in the middle of that. And OEMs are struggling to get their capacity, suppliers to be delivering to the level what they need, and we are one of the performing supplier for them, and we are performing for years together for these customers, and we have a very strong relationship with the customers like Airbus, and so that's continued to happen.
Just wanted to get a understanding there. You spoke about the fact that aerospace is a much mature business for you in that sense. 83%, 84% of your revenues come from there. Is the aerospace business profitable at a net level?
Yes, it is, and that's what I was saying. It's been a 15 years journey in this industry for aerospace for AEQUS, and it has been profitable post-COVID. Obviously, before COVID also, post-COVID, we went through the tough time and COVID time, and then because industry overall come down 65%, post-COVID consistently be growing and have been a profitable business, net basis, net profitability level, and we believe we'll continue to do that because it's a mature business, and that's why when you look at it, you have to look at us as an aerospace business which is matured and delivering, performing, and top performing supplier for our customers. Then we have upcoming consumer side of the business, especially focused on consumer electronics.
Is it fair to assume that given that you're using a large part of your proceeds to pay off some of the borrowings, that will bring down your current borrowings from which is at around 533 odd crores to negligible levels? You will exit FY26 on a profitable note?
Look, I mean, if you look at the path, we are already, if you look at year on year, our profitability has improved. And we believe, as the consumer utilization happens further, we are at low as 22% in consumer side. And as utilization improves, and that should be the, what we should be trying to achieve as utilization improves. And we'll be getting to profitability because the consumer is the driver for not having profitability for us right now.
Take us to your consumer business now. You're already into a mature business, which is aerospace. Consumer is something which is new for you. How big is and which are the segments in the consumer electronics that you're catering to, and what kind of order book you have from there?
I mean, look, our consumer has, we have a consumer, we are in a toys business, consumer durables, which is a joint venture with Tramontina. And then we have a consumer electronics, which we started about 24 months back, and that's predominantly we are in the portable computers and smart devices, wearables devices. That's what we are in the business of that, manufacturing, high precision manufacturing, mechanical side of the, mechanical portion side of the business. And we are just a beneficiary of just announced ECMS scheme, which the central government has given a PLI, and we are one of the qualified supplier for that, qualified partner for that. And so those are the three areas we operate in within the consumer. And our significant investment in recent past has been towards the consumer electronics.
And within that, do you have firm commitments from any of the customers there? Because you are getting into a PLI, there are commitments that you have to make with respect to revenues coming in from there. So what is the kind of revenue commitments that you have made?
I mean, we are working with the customers to, do what is, with the visibility what we have, and we have made a commitment to the governments in terms of our investment strategy, and ultimately it is our responsibility to make sure that we execute that. And we feel comfortable where we are with respect to overall. I think we have to thank the government for bringing the ECMS scheme, because that helps us bridge any kind of the disabilities we have against existing suppliers in the east, and then we were able to deliver value to the customer, because whole idea has been to increase the in-country value add, in whether it's an aerospace or consumer side. We are doing that. That's our number one goal. That's how we have built this foremost vertically integrated engineering-led precision manufacturing ecosystems over both aerospace, and now we are establishing for the consumer electronic side of it. And that's the only way we can deliver value to our customers and retain value in India as a country.
So currently, 84% coming from aerospace, and over a period of time, you'll have the consumer electronics also taking a larger pie of your revenue. What would be the kind of revenue mix breakup between both the segments for you?
It's not necessarily more of a segment percentage or anything. It is more because the opportunity to grow each of these businesses is humongous. And that's what I was coming back to, that addressable market is very large for both aerospace side and the consumer side of it. So we really don't, we don't really dictate the percentages, but we let the market, and our execution drive the, the growth of each of these businesses. And we feel very comfortable where we are right now to be able to take the, the best possible growth path. Actually, it's more of execution.
And how do you look at the margins from the consumer electronics business? Because margins are very thin, especially for some of your competitors who are into it already. The margins are very thin compared to what you are now getting in the aerospace business. So how do you manage both ends in that sense?
We are actually we are a component manufacturer in the consumer electronics industry also. So your mechanical component, if you look at our, the PLI approval, it has been mechanics and enclosures, and that's what the kind of work we do in this thing. We don't really do a final assembly and testing type of activities. So we are more of a very much, a precision manufacturing company, and that's what we do in consumer electronics also. Although it's a vertical, but actually we are doing a mechanical portion of the consumer electronics. That's the distinction you need to look at.
And will the blended margins continue to be in the range or current range of 15 to 16%?
We believe our aerospace industry, and because there's a similar type of value add we are carrying out, it should be, we should be at, the end of the day, the business is very similar.
You also have exposure to Indian markets as well, and within the Indian markets, the aerospace industry is also flourishing. You have newer projects coming in and new there. Are you participating in some of the Indian orders which are coming from some of the Indian OEMs like PSU OEMs and all?
Actually, if you look at it, our aerospace, our India exposure is predominantly, even there it's for exports. Actually, some of our customers are in India, but further their value add in value add and then exporting it back into, for example, Collins. We supply them in India and they value add and then ship it to their end export perspective. But having said that, our today business majority is the consumer, commercial aerospace, in the aerospace side of it. And we are expanding into supporting the India defense side of it. And we are doing some programs. We support HAL. We have projects from them. We continue to work on the various partnerships to make sure that we deliver value to the, bring more content of the defense side, Indian defense side. And because we have significant capabilities to support that, and it's just making sure that we have right programs and right requirements are met. So we have a team which works continuously on that activity.
I want to just come back to the orders book for you, because you said you are involved very closely with commercial OEMs, the Airbus of the world, and they have a order book which is much bigger and to be delivered over the next 5 to 6 years or 10 years basically. Do you also get that kind of forecasting or orders in advance over a period of time, and what is normally a order book execution period for you?
Typically, we are quite a bit of single source or at most dual source on some of the components on their programs. And as their order book is there, it reflects into similarly our order book also in at least 5 to 7 year time frame. So that's how we are. That's how we feel very good about our visibility in the aerospace business because it's a long term, because their order books are very large, and that reflects back into our visibility in aerospace, commercial aerospace order book.
And is the entire risk of raw material pricing already priced in your contract, or do you have to absorb it whenever there is a fluctuation globally on this?
Yeah, typically what happens in the aerospace, in the commercial aerospace industry, OEMs, large OEMs have their material contracts, and typically they enable it to us, and we procure through that. And with that, customers really take care of the material fluctuations automatically on the back end. And so that's not really an impact to our business generally. But, then sometimes we have to work with each customer, smaller customers, to see how, every time that any changes happen. But typically, it's a back-to-back kind of agreement.
Aravind, it was a pleasure talking to you today. Your IPO is opening on December 3rd, closes on December 5th. Price between 118 to 124. It's a IPO of 922 crores. They've already raised 144 crores as a pre-IPO placement, and the company is valued at a little over 8,120 crores at the upper end of the price band. Thank you very much for joining us today on ET Now and coming on IPO Central actually.